The market narrative right now is screaming 50% collapse incoming. But when you strip away the emotional headlines and examine the structural data, the reality is radically different. In the span of just 60 minutes, over $230 million in leveraged long positions were liquidated. That kind of event used to fracture confidence across the board. A year ago, an asset like XRP would have cracked under that pressure. It didn't. We are in February 2026, and something fundamental has changed. The retail purge is complete. The frantic selling that used to define every tariff headline has been exhausted. What remains is not noise. It is silence. Institutional silence. Today, we decode the divergence. While the world prepares for a dramatic breakdown, internal market structure is signaling stabilization. Gold reclaiming $5,200 per ounce is not just a price milestone. It is a macro alarm bell for the global monetary framework. When capital migrates toward hard assets at that velocity, it signals stress, but it also signals rotation. Liquidity is not disappearing, it is repositioning. The recent liquidation cascade was surgical. Following renewed tariff rhetoric, the market responded instantly. Leveraged longs were erased in a single one-hour window. This was not casual profit-taking. It was a forced unwind of excessive leverage as traders recalibrated to new economic risk. Bitcoin briefly slipped under $65,000. XRP mirrored the move almost perfectly. During macro stress events, the correlation tightens. These assets move together when global uncertainty spikes. This was not about technology failing. It was about macro fog descending across the entire financial system. When geopolitical tensions escalate, particularly between the United States and Iran, liquidity thins, volatility increases, investors de-risk, gold and silver attract capital. The reclaim of $5,200 per ounce in gold confirms that capital is seeking shelter. Risk-on appetite has temporarily faded, but here's the key question. Are you reacting to price fluctuations, or are you observing structural resilience? To understand the magnitude of what just happened, we need context. Go back to February 2025. When reciprocal tariffs were first announced, XRP collapsed from approximately $2.79 to $1.76 within 24 hours. Nearly a 50% wipeout. Retail panic dominated the chart. Emotion ruled the tape. Now compare that to today. The current tariff language is, in many cases, even more aggressive than last year's announcements. Yet daily price movement has been comparatively muted. After the initial Sunday correction tied to renewed tariff threats, XRP did not enter a free-fall cycle. Instead, it stabilized. It found support. It rebounded. That difference is not random. Just days ago, XRP rallied toward the $1.46 region before tariff headlines resurfaced. The retracement that followed did not break critical structural support levels. That refusal to collapse tells a larger story. The weak hands have already exited. The traders who once panic sold at the first hint of macro tension were systematically flushed throughout the past year. What remains is capital with longer time horizons. If retail is no longer driving emotional sell-offs, then what explains remaining downward pressure? Institutional rebalancing. Large funds adjust exposure clinically. They reduce risk methodically, but they do not panic. The absence of a violent single-day 50% decline confirms that XRP is no longer behaving like a fragile speculative instrument. It is beginning to trade like infrastructure. We may see marginally lower levels before this process fully resolves. I am not declaring the storm over, but the architecture of collapse that defined prior cycles has weakened. Are you seeing minor dips and feeling fear? Or are you recognizing the death of panic selling? Global markets are currently operating in high-stress mode. Political friction, trade uncertainty, and judicial gridlock are creating background instability. But instability does not equal destruction. It often precedes transfer. The panic is emotional. Accumulation is strategic. The silence of retail selling is not weakness, it is exhaustion. Gold's reclaim, Supreme Court tensions, geopolitical deadlines. These are macro signals of transition, and transition periods forge bottoms, not tops. You are not holding a meme token reacting to social media sentiment. You are observing an asset that just endured one of the most aggressive leveraged flushes of the year, and held. I remain calm because the data demands calm. If you are watching headlines, you will see fear. If you are watching structure, you will see resilience. And resilience is what bottoms are built on. I am the calm analyst. If you are finding value in this macro breakdown, make sure you support Reverse Crypto by hitting the like button and subscribing. The next phase of 2026 will not reward emotional traders. It will reward those who understand stress physics in financial markets. Stay patient, stay precise, stay analytical. Underneath all this volatility, there's another layer most people ignore: community positioning. While the broader market is distracted by unrest, we're doing the opposite of panic. We're rewarding discipline. And that's why I've locked in a major partnership with BTCC, one of the longest-running crypto exchanges in the space, operating since 2011 and serving over 10 million users globally. This is not just a logo on a screen, it's access to deeper liquidity, serious tooling, and up to 500x leverage for the traders who actually understand how to manage risk instead of gambling into liquidation. And we're turning that into something real. We're launching a London VIP experience. 5 winners plus a guest will be flown to London, expenses paid, to meet me in person and watch England versus Uruguay live at Wembley Stadium on March 27th. This isn't about a random giveaway. It's about celebrating the mindset that survives these macro storms. London is one of the most important financial hubs on Earth. The symbolism matters. When the world is noisy, sovereign thinking is rare, and rare thinking gets rewarded. Here's how qualification works, and it's intentionally simple. You sign up on BTCC using the dedicated link. You deposit $500 or more. You trade and generate volume. For every 2 million in trading volume, you earn another raffle ticket. With access to higher leverage, that threshold becomes achievable for active traders who use it intelligently, not recklessly. And if you want to boost your odds without trading, you still can. Join the Discord, +1 ticket. Subscribe to the free newsletter, +1 ticket. Join the Crusaders Academy, +2 tickets. You can stack entries without pretending you're a full-time trader. Now let's talk proof, because I don't deal in vibes. Even as the market dipped under the weight of new economic threats, we executed a short on XRP in the Discord and closed it for a 9.36% gain. Clean, controlled, no drama. That is the Crusader edge, seeing the correction before it becomes the headline, and positioning so volatility becomes fuel instead of fear. This is what most people miss. When markets enter this macro fog, the average participant waits for clarity. They want perfect conditions, perfect confirmation, and zero uncertainty. But the market never offers that at the true bottom. It offers confusion, discomfort, and headlines designed to trigger weak hands. That's why the retail crowd gets shaken out repeatedly, and that's why what we're seeing now matters so much. The violent retail reaction is gone. The remaining downside, if it shows up, will likely come from institutional rebalancing, not emotional capitulation. That's a different kind of pressure, slower, more controlled, and far less explosive. It's also exactly what bottoms look like before they harden. So yes, I'm still open to more downside. I'm not pretending this is fully unwound. But the structure has changed. The market is no longer behaving like it's on the verge of a total collapse. The volatility spikes are being absorbed, not amplified. That's why my approach stays clinical. We let the storm finish expressing itself. We identify the true floor, and when the bottom is confirmed, we buy the dip with size. Until then, we keep extracting opportunity from volatility, like we just did with that Discord short. And here's the broader frame you need to hold in your head. The United States is in a visible state of political tension. Trade policy uncertainty is pressurizing markets. Geopolitical deadlines are tightening. Gold reclaiming $5,200 is screaming risk off. But that doesn't mean crypto is dead. It means capital is temporarily seeking shelter while the next allocation decision is being made. The panic is retail emotion. The accumulation is institutional behavior. Are you waiting for a clear sunny day to buy? Or are you watching an asset hold its structure while everything around it turns unstable? Because that is what resilience looks like. If you've been looking for the signal that the panic sellers are exhausted, this is it. The crash didn't arrive the way it used to. The old architecture failed to trigger. The market tried to break it, and it refused. You're not watching a meme trade. You're watching an asset that is beginning to behave like it's being held for utility, not hype. I am the calm analyst. If you got value from this breakdown, support Reverse Crypto by hitting like and subscribing. And if you want a shot at the BTCC Wembley VIP getaway, make sure you enter through the official link, stack your tickets, and put yourself in position to be in London next month while the market writes the next chapter. Stay patient, stay clinical, stay safe.